Hey folks, and welcome to the Pipnotic Symposium for the 9th of August 2021. So today we're going to talk a little bit about liquidity voids and what they are, because they're really important and they essentially are going to help us know what direction we need to trade. And so first of all, a liquidity void can be, first of all I'll show what they are and then I'll discuss what they mean. And so liquidity voids are pretty easy to spot. They are price points, or rather price patterns. Hope it's not too windy. It's a little bit windy upstairs here. I'll try and duck a little bit below the ledge. But they are price structures where price trades inefficiently, where price leaves or moves very quickly. We have one here, we have a small one here, have a little one here, we have another one here. So on this chart we have few. We have a small one, a very small one just here, another very small one just here. And what they mean essentially is that from about this point here to about this point here, the liquidity for this asset dried up. And what that means is, it means that, well, essentially it'll mean that price can move very quickly, both higher but also lower. And this is because there is no liquidity available at this area. Price moves simply too quickly. And when this happens, no buying and selling, or very limited buying and selling, will typically occur within this period of trading. And this is because price is moving too quickly. And so it's not possible to fill orders because price is on the move. Okay, and so what happens typically is price will leave quickly and then it'll stabilize. And then when price stabilizes, then you tend to see these more liquid periods of trading where price moves efficiently sideways. So this is, I've said this, I don't know, probably several 100,000 times during the course of the maybe 5-10,000 videos I've done over the many years, but I always say, like, price inefficiency or liquidity void. Okay, and where you have inefficient trading like this, and this, you have efficient trading as well. Okay, and so this is efficient trading here, like around here. Efficient, a little inefficient, efficient, efficient, inefficient, efficient, inefficient, efficient, a little bit inefficient here. This is efficient, inefficient, this is efficient, this is inefficient, efficient, so on and so forth. So essentially where you see price moving in like a small range like so, where price just kind of moves around, goes above, below a little bit, but it's constantly rebalancing. When I say rebalance, which I've also talked about a lot, is when price leaves us out of balance, when it returns to the origin of the move, it's in balance. Okay, so from here to here, we had an imbalance, and when price returned to the origin, it was rebalanced. Okay, but now we have this one that has to bounce, so price will typically go up and down and up and down. And so if you want this to be filled efficiently without creating an inefficiency, price will have to go like this to move higher, trade efficiently up to the origin of this move. Okay, and the reason this is important is because when you have a price chart like this, now this is some people were talking about the American dollar, Japanese yen in the trading room, and they were talking about specifically this pair, and I'll just use this as the example where we had, if we go to, I think it was a 4-hour chart, where we talked about there's this chart here. So okay, here it is. So we're talking about this price structure here. Okay, and there was reference to this price point here. So we had this area of, we had this price imbalance, price rebalance, return to the origin of the move. Okay, price came down. Okay, we moved sideways. We created an imbalance. We returned to the origin, rebalancing. We left. We created a price imbalance or liquidity void. Price moved down. Price moves back to the origin of it. And now we're doing the same thing, but in the opposite direction. How price moves sideways, we move up. We rebalance this small one. We move up, but we have still yet to rebalance this one here. Okay, and this is important to us because price will typically rebalance at some stage. It'll return to here, and above price you can see we had this one just here. I'm going to use it, I shall use this tool here. We had this one here. Price left, price traded up into it, essentially rebalancing that. And so you have to ask yourself the question when you look at a price chart. You said, like, where do we have price movement that is out of balance? Where do we have liquidity voids that have not yet to be balanced? And you can see that we have this one here. Rebalancing it would essentially bring it back down to here somewhere. We have this one here that we've just marked off. This one has been rebalanced, so price will probably want to move higher. It might move down here and then move higher. But above that, where do we have something? We have something here. We have something here. And so we do have a couple of price imbalances that need to balance still. Okay, and so the reason that it's important to know where they are is because if price moves very far over a limited period of time, it will return back to the origin of that move within a limited period of time. If price moves very far over an extended period of time, price will typically return back to the origin of that move over an extended period of time. When I say extended period of time, I mean if you're looking at, let's just go to a different chart. Let's just put on this one here. This is the daily chart. Okay, so I mean, where do we have the really big price imbalances? We have this one here. This is a gaping price imbalance, liquidity void. Price managed to come back here, so this is telling us where the beginning of the buy zone is, but this one here is yet to be rebalanced. We have this one here. Price came a little bit down here, but so the buy zone is here. We have this one here that has now been rebalanced, so price came back to it. We have this one here that is yet to rebalance. See, this one here has been rebalanced, but we maybe want to go and fill this one here, so price will potentially wriggle higher to this area of supply that has been tested a couple of times. Okay, and so this is what you want to do. You want to, and I've spoken about this extensively on many of my older videos where I talked about currency strength, where you have typically, I'll just draw it here. So you have the zero line, and you have one currency is getting strong and the other one is getting weak. So let's say this is the American dollar, and this here is the Japanese yen. If you have a strong American dollar and a weak Japanese yen, what direction is the American dollar Japanese yen going to be moving in? Well, it's going to be moving higher. And this is because the thinner side of the market is above price and the thicker side is below price. And when I say thin and thick, I mean so if we draw this little graphic that I like to use, where we have volume, we have time, and this is the volume here, and this here is a spot price for an asset. Let's call this S. This is a spot price. This is where price is right now. Liquidity, or volume available, the volume of liquidity available right where price currently is generally relatively low. But the higher price goes, the more interest there will be to sell. The lower price goes, the more interest there will be to buy. Okay, and so if price, so if you look at it, okay, let me zoom out a little bit. Okay, so if you look at this, let me zoom out even more. Okay, so if you look at this one here, this is a really nice one. Okay, down here, when price was down here, we created a liquidity void. We left a liquidity void in the wake of this move. And if we draw that little graphic, so we go kind of overlay it. Oh, that wasn't very pretty, but good enough. Volume, we have time, and we have the spot price right here. Okay, and so the higher price goes, the more interest there will be in selling. The lower it goes, the more the interest will be in buying. Okay, and so you're seeing this all the time. And so if you have price that does this, something like this, okay, I mean, the thinner side of the market is down, but the reason it stopped is because it was a discount price, and so the liquidity down here is higher than it was here, for example. So price, we have high liquidity here, it goes high, it goes lower, and then it goes high again here. So if you were to draw that for this candle, it would look something, turn all these little, if we did it for this one here, it would look something like this, where it'd get, if we draw lines, it'd be big orders, slightly smaller, and maybe there aren't even any in the middle here, then it picks up once we get to the bottom. Okay, and so the same applies for this. Here's the thick liquidity, thin liquidity. Okay, it looks something like that. And so when you're looking at what other tools do that? Market Profile. Market Profile does that. I read a really great book, an old book. It was written maybe in the 90s by the gentleman who introduced Market Profile, and it was a fascinating read. And it talked essentially about this, where you have liquidity that is essentially distributed higher above price and higher below price. Okay, and when you have something as I refer to as liquidity void, like you can see here, see one here, you can see one here, have another one there. They're all over the place, and this is why the software focuses on them. And you can turn these on in the software. I call them price imbalance bars. Here you turn that on, and the software is going to draw them, and it's going to show you where they are, because they're really important. Because if you have a price imbalance bar like this one here and this one here, when price leaves like that, price will very likely return to the origin of that move. Okay, here we have another one. Price left, price came back to it. We have another one. Price went up, it went down, and it came back up to roughly the origin of that. So you're going to see these all over the place. Price left, price came down to it again. Okay, so this is a constant struggle between buying and selling, and the struggle between buying and selling, sometimes you're just going to have more buyers than sellers, and so the price will go up. And if there are way more buyers than sellers, then price will go up very quickly and very inefficiently, because there'll be so much buying going on that price will simply jump over price points, because there will be no selling pressure anywhere in that price pattern. So price will jump higher, and because of that, it's created this liquidity void, or a price inefficiency, or a price imbalance, whatever you want to call it. And these will have to rebalance at some stage, because it's an inefficient market, and essentially you want to ensure that we're trading efficient markets. Okay, high liquid markets. Okay, so when price leaves like that, we can expect price to go. And this is why the software is so bloody good at what it does, because it finds these with relative ease. We had this one here, where when this candle closed, it drew this box head and said, so once price comes up there, alrighty then, you put your limit order in, or you wait for price to come up there, you wait for a small confirmation, whatever you want to do, then price goes in there, then it leaves. We had another one here. We had another one here. Price left, price came down to it, and we got about a 2 to 1 out of that one. The second time it went through it. So you're seeing these all over the place, and this is why the software is so works so well, because it's so good at finding these patterns. So we go to a slightly smaller time frame. Let's maybe go to the 15-minute chart, and you see something like this. Okay, and when you see something like this into historical area of supply, that's a really good time to sell. So if this, maybe it is, let's just have a look on maybe an hourly chart and see what we have. Yeah, we have the beginning of a sell zone. So we have, and the sell zone is simply where price goes to, then rejects from. So we had a sell zone, so this tells us that above this price point we have an interest to sell, or we have historically. Okay, price went up there, and now it's starting to retrace. And when you move into something like this, where you have kind of support becomes resistance, and price pokes into it, and you leave a liquidity void or price imbalance below price, well then price will need to rebalance at some stage. Okay, and I currently have an ongoing discussion with my old mentor, Chris Laurie, and I've posed these questions to him, and he's been quite busy traveling and stuff, but he's agreed to a call tomorrow, and tomorrow we're gonna go through all of these things, and I'm gonna ask these questions that I have. I have an A4 sheet of questions about the patterns that I've been looking at over the course of many years, based on the development of the software, and also conversations I've had with other traders and other mentors who have been talking about the same thing. And it's really fascinating, and I think it's time that I went back to I went back to the basics and understood exactly what it is that's going on. And these things are called several different things depending on who you speak to, but they're essentially the same thing. Okay, you have price that leaves equilibrium, then it comes back to it. Okay, and so yeah, I mean you have also, there's this concept of price is too low or price is too high. So you have, I'm just going to draw like a couple of price points like this. Okay, so if you have price doing this, price comes up and people are happy buying. Price inefficiency, price goes up. Price inefficiency, price goes up. Then price comes down pretty quickly. Okay, if price was here and you were concerned, let's say this was Bitcoin and price was here, then you thought, oh, that's too expensive, I'm never going to pay that, it's way too expensive. But price continues to trade higher. Then you think, oh, actually this is expensive, this one was actually cheap, and then price goes up and it goes high, and you think, actually this one is expensive and this one was cheap and this was a smoking deal. And then price comes all the way down and it comes down here. Then you think, okay, I finally got that good price, this is really expensive, I'll never pay that price again. But price is down here, but price goes up here and it does the same thing. They think, whoa, actually this was a smoking deal, the really expensive one that I said was expensive is actually really cheap, so if it comes down there, then I'd love to pay that price. But price is up here and maybe it doesn't ever come down, or not for a year. But if price is leaving these price inefficiencies, these liquidity voids, in the wake of these huge moves, at some stage price will have to come back and rebalance it. Okay, and this is what I need to find out is how long this takes, because this is something that's pretty essential to understanding liquidity and liquidity voids. And so this is a very interesting point, and this is something that I tend to get the answer to here within the next couple of days. So when I have this information, then I'll of course share it with you all. But it's I hope I didn't kind of go off on a tangent there about liquidity voids. A liquidity void is essentially, just to recap, a sharp move in price where there is no bids or offers. Price moved too quickly, too inefficiently. It could not fill orders in that space, in that period of time, and so price will leave like we have here. And so now price will probably wriggle down here to rebalance, and then it'll figure out what else it has to do. Above price, there's nothing to do. We still have to rebalance this, so price could eventually make its way down to here in order to rebalance this price inefficiency. Okay, good. Well, I'm going to leave it at that. I hope that wasn't too confusing. If you have any questions, let me know. And thanks again for watching.